Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. We're here for another deep dive, and our mission, as always, is to cut through all the noise and extract the most important nuggets of knowledge and insight from that stack of financial news sources you've shared with us. Today, we're taking a deep dive into the latest global financial headlines. We're focusing particularly on those shifting trade agreements, some big company news making waves, and that absolutely jam-packed economic calendar shaping markets this week. It really does feel like the Olympics for market watchers this week, doesn't it? I mean, every single day brings a new event, a new potential hurdle.
It absolutely does. A financial decathlon, you could say. And to help us make sense of it all, our material today comes mostly from recent articles, live updates from, the big names, CNBC, Bloomberg, Reuters, Yahoo Finance. All these reports landed right around July 28th, 2025. So it gives us a really current snapshot, allows us to connect the dots across these up-to-the-minute reports.
Okay, so get ready for a concise, but hopefully thorough understanding of what's driving the markets right now, why it matters to you, and what to keep a very close eye on. All right, let's unpack this first major event then. We really have to kick off with the biggest news on the trade front. The U.S. and the EU.
Oh.
They've struck a framework trade deal. This was announced Sunday. President Trump, European Commission President Ursula von der Leyen. And initially, you just feel this collective sigh of relief across the markets.
Absolutely.
Because this agreement, it directly prevents those frankly, crippling 30% tariffs that were threatened on most EU goods, tariffs that could have kicked off a full-blown trade war.
That's the crucial bit, avoiding the worst-case scenario. And the specifics, while they're fascinating, they really show the give and take. So the deal sets a 15% tariff on most EU goods coming into the U.S., and that includes cars, which is obviously a big one. But importantly, it's not a blanket tariff. Some key items are exempt. Think aircraft parts, certain chemicals, some generic drugs too, semiconductor equipment, even some farm products and natural resources. And on the other side of the coin, the EU has committed to purchasing, get this, $750 billion worth of U.S. energy.
Wow.
And investing an additional $600 billion in the U.S. above what they're already doing. It's a significant financial flow shift, wouldn't you say?
Absolutely. It's a massive commitment. But, even with avoiding that full-blown trade war, we're seeing some really mixed reactions coming out of Europe. So leaders like Germany's Friedrich Merz, Italy's Giorgia Meloni, they welcome the clarity, the fact that escalating conflict was avoided. But then others, like France's Benjamin Haddad, have called it unbalanced. Why the hesitation? What's the nuance there that makes some leaders feel, well, like they didn't get the best deal?
Yeah, it really comes down to perspective, doesn't it? And the baseline you're comparing it to. So analysts like Caitlin Birch from the Economist Intelligence Unit pointed out, okay, 15% is better than 30%, sure, but it's still a big escalation from where we were pre-Trump 2.0.
Right. It's not zero.
Exactly. It's a permanent new hurdle compared to basically nothing before. Holger Schmeiding of Berenberg, he went further, called the deal asymmetric. He suggested the U.S. got a pretty substantial increase in tariffs and those big concessions, while the damage to Europe is more front-loaded, meaning they feel the pinch of those higher import costs straight away.
Okay.
But, on the more optimistic side, you've got Michael Brown at Pepperstone. He sees this deal as removing a key left-tail risk from the market, that big, unpredictable negative event. And he thinks it signals a general move towards more trade agreements, not escalating fights. So, yeah, it's a mix of relief, definitely, but also this lingering sense of maybe an unfair bargain for Europe.
It's fascinating. One agreement viewed so differently depending which side of the Atlantic you're on. And this definitely introduces a ripple effect for global trade flows. It's like redirecting a massive river, isn't it? And here's where it gets really interesting for the big picture, beyond just the U.S. and the EU.
Indeed. There's this tool, the OEC Tariff Simulator, a pretty powerful forecasting model, and it gives some compelling projections based on this deal. It predicts, quite dramatically, a 46% drop in global U.S. exports by 2027. That's a huge number, like $2.68 trillion less than previously expected.
Wow, 46%. That's a massive number.
Yeah, but hold on. It doesn't mean the U.S. stops exporting. It means global trade patterns shift away from U.S.-centric routes. But conversely, it also predicts a 12% increase in U.S. exports to the world overall, a gain of about $1.6 trillion.
Okay, so exporting more to some places, just less volume maybe to the EU than before.
Exactly. It's complicated. But what's really eye-opening is the predicted rewiring of trade relationships. The simulator suggests the U.S. will actually import more from countries like the UK, France, Spain, but less from major partners like China, Canada, Mexico.
Hmm.
And flipping that, China is expected to import more from Russia, Vietnam, Saudi Arabia. So this isn't just tweaking things. It's a potential, decoupling of global supply chains from the U.S. It accelerates a trend we've already seen brewing, and it forces companies to make some really fundamental choices about their long-term market access.
So, okay, let's bring it down to the ground level. If you're a consumer in the U.S., what does this layering of tariffs, as they call it, actually mean for your everyday life? Logistics experts are already warning, right? Even with lower tariffs than threatened, products are going to cost more to import.
So it seems likely, yes.
And maybe even more noticeable, there's a real worry about less product diversity on U.S. shelves, something American consumers have really gotten used to. We saw IKEA mentioned as the top U.S. company importing from the EU, like 28% of their total imports, and Southern Glazer's Wine and Spirits at 9%. So certain sectors are definitely going to feel this.
Absolutely. And it's not just Europe, remember. Japan also struck a deal with the U.S., same 15% tariff on Japanese cars and other goods, though their trade negotiator, Ryosei Akazawa, clarified something important about that $550 billion U.S. fund in their deal. He said a big chunk of it is actually loans, not direct investment. Only maybe 1–2% is actual equity.
Ah, okay. That's a key distinction.
It is. And furthermore, even avoiding higher tariffs, Japanese automakers, they still face this major long-term threat from rising Chinese competition that's really eroding their global market share, especially in places like Southeast Asia, Australia. It's a multifaceted challenge for them, to say the least.
Okay, let's shift gears a bit. Let's focus now on some specific company movements, regional market snapshots, because these individual plays are just as critical in our market Olympics here. Looking at Asia-Pacific markets, Monday ended kind of mixed, right? South Korea's Kospi up a bit, Hong Kong's Hang Seng up, Australia's S&P SX 200 up 2, but not gains everywhere. Japan's Nikkei 225 fell over 1%, and India's Nifty 50 dropped about 0.65%. So a real mixed bag.
Yeah, definitely mixed signals. But diving into some of the major company headlines, there's a really significant one, Samsung and Tesla. Samsung Electronics shares surged over 6% after they confirmed a massive $16.5 billion contract to supply semiconductors to Tesla.
Oh, $16.5 billion.
Huge deal. And Elon Musk himself confirmed it on X. Said Samsung's giant new Texas factory will be dedicated to making Tesla's next generation AI6 chip.
AI6 chip.
Yeah, it's a custom processor designed for really cutting-edge AI computation. Musk even posted that Samsung would let Tesla help maximize manufacturing efficiency. I mean, this is a huge win for Samsung's foundry division, which has been underperforming, frankly. They're trying hard to catch up to competitors like TSMC in that crucial 2-nanometer fabrication space.
Right, the cutting edge.
Exactly. That's the groundbreaking tech for powerful, efficient chips. It sets the bar for next-gen electronics.
That truly is a game changer for the whole chip landscape. Creates ripples far beyond just those two companies. But then you get these fascinating paradoxes, like with the Chinese jewelry brand Laopu Gold. Their shares actually fell. Despite forecasting this incredible 279% to 288% jump in net profit for the first half, what's going on there? It seems totally counterintuitive.
It does, doesn't it? But it's kind of a classic case of market sentiment versus strong fundamentals. Analysts are saying the fall is due to profit taking. The stock had already gone up like 2,000% since listing last year.
2,000%.
Okay. Yeah. So some profit taking, maybe a reset in market expectations, and also a broader trend. There was a survey by Oliver Wyman finding that affluent Chinese consumers are shifting spending, moving away from luxury goods like jewelry towards experiences like travel.
Interesting.
So it highlights this fascinating divergence. A company can have incredible profit growth, but market perception, broader consumer trends, they can still pull the stock down. Sometimes it's not what you earn, but what the market thinks you'll earn, right? A humbling lesson.
Definitely. Speaking of declines, we saw a sharp one for Advantest, the Japanese semiconductor equipment maker.
Yes, their shares plunged over 10%. This happened after they disposed of treasury stocks as restricted stock. Now, for listeners maybe not familiar, that's a common way companies compensate employees using shares they've bought back. But the market reacted negatively, probably saw it as diluting existing shareholder value.
Okay, makes sense. And then there's CK Hutchison. That looks like a very strategic move they're making, more than just a business deal.
Oh, absolutely. Hong Kong's CK Hutchison is looking for a Chinese firm to be a major strategic investor in its huge $22.8 billion ports business. This is widely seen as a move to, well, ease potential challenges from Beijing regarding its interests, especially since two of the ports involved are right along the Panama Canal.
Ah, strategic location.
Very strategic. So having a Chinese investor on board, it likely alleviates potential geopolitical friction, aligns economic interests with broader strategic ones. A very calculated move.
But hey, not all the news was mixed or down. We saw some significant regional highs too, didn't we?
That's right. Vietnamese stocks, for instance, hit a fresh high. That's 5 sessions of gains in a row.
Nice run.
And Indonesian stocks reached a 9-month high, rallying for a 4th straight session, mostly driven by utilities, financials, real estate sectors there. It's a good reminder that even when global headlines are messy, localized strengths can definitely shine through.
Yeah, absolutely. It shows how these regional successes often reflect specific local economic factors or investment flows, kind of separate from the bigger market churn, highlights the granularity under the main headlines.
Okay, so if last week felt eventful, this coming week, it truly is the Olympics for market watchers, as that analyst put it. We are facing an incredibly hectic week for U.S. markets, just packed with critical events.
You are not kidding. The schedule is just, wow. Okay, first up, earnings season. Still roaring. Over 150 S&P 500 companies reporting, and that includes the big ones, the Magnificent Seven heavy hitters, Meta and Microsoft on Wednesday, then Amazon and Apple on Thursday.
Yeah, huge names.
Huge. And investors will be listening so closely, not just to the profit numbers, but for any comments on AI spending.
Yeah.
That's been such a massive driver for their valuations, their future growth outlook.
Absolutely critical theme.
Then, smack in the middle of the week, we get the Federal Reserve's two-day policy meeting. It wraps up Wednesday. This is like the cornerstone event in our Olympics, right?
Definitely a main event.
And while the market is pricing in, what, a 97% chance of rates holding steady, current range 4.25% to 4.5%.
Yeah, that's the overwhelming expectation. Hold steady.
But everyone's looking for clues. Any hint about potential rate cuts later in the year? Or maybe a firmer stance on inflation watch. Just reading the tea leaves from the Fed statement and Powell's press conference.
Exactly. The forward guidance is key.
And that's not all. Thursday brings the PCE price index, personal consumption expenditures. This is the Fed's preferred inflation gauge, right? Because it captures a wider range of spending, generally less volatile than, say, CPI.
Correct. It gives a broader picture.
In this report, it's expected to show inflation actually ticking up slightly, maybe 2.4% year over year, up from 2.3%, and higher on a monthly basis, too. This is going to be a key indicator of how these new tariffs might be feeding into overall inflation, directly impacting, your purchasing power.
A really crucial data point, especially with the tariff backdrop.
And then, to cap it all off, we get a whole slew of employment reports through the week, leading up to the critical July jobs report on Friday. These will give us vital insights into the labor market's health, its trajectory. Economists are sort of expecting maybe a slight bump up in the unemployment rate. It is truly a gauntlet of data this week.
It really is. Yet, despite this incredibly busy week, all this looming data, U.S. equity futures actually rose early Monday, building on what was a winning week last week for all 3 major averages. The S&P 500, remarkably, marked its 5th consecutive record close last week. So that signals pretty sustained bullish sentiment, doesn't it?
It does, surprisingly strong.
But there's a but. Some analysts over at Citi Research, they're noting that market sentiment has returned to levels they call euphoria.
Uh-oh. Euphoria usually isn't a long-term positive sign.
Historically, no. It can often precede weaker returns. They point to things like the resurgence of meme stocks again and a decline in hedging activity as factors contributing to this, well, perhaps overly optimistic mood. Almost like a party before the final toughest events.
So, yeah, what isn't happening this week? The question is, can this bullish narrative hold up through these Olympics? Or will one of these many data points, or maybe those trade tensions simmering, trigger a real shift, maybe even a correction? To the ultimate test of market resilience, I suppose. Okay, let's widen the lens again. Beyond just economics, let's dive into some deeper geopolitical and tech dynamics that are also shaping the global landscape, because these arenas are just so intricately linked. So beyond the tariffs, U.S.-China trade talks are actually set to kick off in Stockholm today.
Right, that's happening now.
Led by U.S. Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng. Bessent apparently expects a trade truce extension, but these talks, they're going to cover a broader range, things like Beijing's oil purchases from Russia and Iran. So definitely bringing the geopolitical layer into the economic discussion.
Yeah, and that brings us right back to the ongoing Russia-Ukraine conflict. which, often gets pushed down the news agenda amidst all these trade wars. President Trump recently gave Russia that 50-day deadline, remember? Reach a peace deal with Ukraine or face very severe sanctions, potentially secondary tariffs up to 100% if they don't comply by September 2nd.
Mm-hmm. Strong words.
Strong words, but analysts are pretty skeptical this will actually move Putin, especially because serious secondary sanctions could mean, quote, quarreling with China and India.
Right, major buyers of Russian stuff.
Exactly, major buyers of Russian commodities. So that's a really delicate diplomatic tightrope to walk. And Ukraine, meanwhile, they're facing their own internal challenges. Consolidation issues, protests over anti-corruption agency reforms. It just adds another layer of complexity to an already incredibly volatile situation. It's a real geopolitical chessboard, high stakes all around.
Definitely. And, while Samsung is inking that massive chip deal we talked about, there's another really fascinating story unfolding in China's AI landscape, particularly concerning the key players and that race for tech supremacy.
It is fascinating, and it's a powerful illustration of that tech decoupling, or maybe realignment we're seeing. U.S. chip giant NVIDIA, conspicuously absent from China's biggest AI event, the World AI Conference in Shanghai. They didn't even have a booth.
Really? Despite hopes of resuming sales of those H20 chips.
Exactly. The H20, that's NVIDIA's chip designed specifically to comply with U.S. export restrictions. But apparently even that hasn't smoothed relations enough for them to have a direct presence there. Now, in stark contrast, NVIDIA's big Chinese rival, Huawei, they had a huge display showcasing their Ascend AI chips, their big computing system, the Atlas 900A3 SuperPod.
Wow.
Yeah, it links like 3 out of 4 of their Ascend chips together. An incredibly powerful system built for massive AI workloads. It just vividly highlights China's really aggressive drive for tech self-sufficiency and also their push for global AI cooperation. Chinese Premier Li Qiang even announced plans for a new global AI cooperation organization there.
Interesting. But other Western firms were there.
Yes, interestingly, other U.S. and European companies did have booths. Tesla was there, Google, Amazon Web Services, Siemens. So it indicates maybe a more selective, complex presence for Western tech firms in the Chinese market now. It's a subtle but really significant narrative playing out in the global tech race.
Wow. So from trade deals literally reshaping global supply chains to individual company contracts impacting billions, and this week of truly critical economic data ahead. It's just so clear how interconnected the world of finance truly is. Every event, every decision, it just sends ripples everywhere.
Indeed. And with that euphoria in the markets that analysts noted, and just the sheer volume of high-stakes events unfolding this week, you have to wonder, right? How might just one single unexpected detail from this week's Olympics ripple through global economies? How could it impact everything from the price you pay for goods to the balance of power in the tech world? And perhaps, thinking bigger picture, will this week signal the true dawn of a more multipolar economic world, where those traditional trade routes get permanently rerouted and, technological independence becomes the new gold standard? That's really the question to ponder as we watch all this unfold.
That is definitely something to think about. Thank you for joining us on this deep dive into the latest financial market headlines. We really hope you feel much more informed and ready to navigate the week ahead. We'll see you all tomorrow morning with new headlines from major financial magazines.